Let's get across the market open now. Kerry Craig joining us from JP Morgan. Kerry, good to catch up with you again. How would you look at the overall investment picture, I guess, when you look at the global picture, if you like, given there is so much volatility at the moment?
Oh, yeah, good morning, Andrew. I mean, there is a lot going on in terms of recalibration in markets. There's expectations around, stimulus measures from China. There's been a bit of a resetting of where interest rates are going in the US as well as in other major markets like Europe. And then we have things going the other way and we look at what's happening in New Zealand. And also there's this sort of thing in the background that's preying on investors' minds, obviously around the US election and some geopolitical events in the Middle East. That's kind of added to some of the apprehensions in markets around the outlook for the global economy is actually relatively robust. And it does seem like we're at a trend like growth. But we have markets that have gone fairly well this year and yields where they've risen a little bit. So there's a question around duration and trying to find that balancing point between wanting to still own risk assets, but sort of mitigating against some of these potential shocks that can come through and upset what has actually been a very positive year for returns across risk assets.
Let's focus most immediately on what we're seeing out of the States at the moment. In fact, we do have US inflation data at the end of this week. How are you seeing that, I guess, particularly in light of what we heard from the minutes in the last Fed meeting?
Yeah, again, that's where that really calibration has really come through. The market pricing for interest rate policy from the US was very much one that saw more easing than the Federal Reserve was saying they were actually putting forth. And I think that's not to do with generally a median view of where policy rates were going in the US. I think that was just to do with the distribution of looking at those market pricing for those measures and potentially more weight being put on a more adverse economic scenario coming through. Since then, we've had obviously economic data that's still been relatively supportive of growth, if not a bit softer. And I think the market has just moved back towards thinking about really the soft landing we're in with the US. That does mean that we should think about potentially a smaller magnitude of rate cuts from the Federal Reserve as it comes through. But importantly, that they are now changing their rhetoric. They're really shifting and reframing how they're thinking about monetary policy away from trying to fight fires when it comes to inflation and more about sort of watering the garden when it comes to actually supporting growth with the liquidity measures they're taking. So we do expect to see rate cuts from the Federal Reserve over the next meetings in the US. So 2 more rate cuts this year, it's 25 basis points, largely because inflation isn't a problem. And when we do get the inflation numbers out this week from the US, I think you're likely to see another step down in that headline inflation. And more importantly, when we look at the core personal consumption expenditures measure of inflation, which is the Fed's preferred measure, if you look at the 3-month run rate on that, it's already below 2%. So inflation really isn't a headwind for them to cut policy. It's how much they want to ease policy to support growth when the economy is still doing okay.
Kerry, equity-wise, what investment opportunities are you seeing in the US at the moment, given that rate easing cycle is now underway?
We are definitely looking for still a proactive approach to looking at equity markets in the US. We do have a preference for the US market, given that it represents quality in the portfolio. It has very high cash flows. We can look at the resilience we've seen in the earnings picture so far. And we're also looking at that valuation distribution between some of those mega cap names and the rest of the S&P 500. And those markets or those companies outside the mega caps in aggregate still trading at a discount. So we think there's opportunities here in terms of thinking about the rest of the market. And as we see the earnings season kicking off in the US this week, obviously it's going to start with the financials and banks, but I think you'll see a better earnings picture starting to come through from those companies outside the mega caps, which will really support that. So very much an active approach to the US. We still have an overweight there because of the strength in the US economy and the strength in the earnings outlook. We have one little bit of caution against how much consensus earnings is looking like for 2025 at close to 15% versus our own views of somewhere closer to 10%. And given that valuations are quite high in the US, there may be a little bit of a lowering expectation about the returns we should expect out of the US market over the coming year as well.
Yeah, of course, as we head into earnings season, which actually gets underway at the end of this week. Kerry, what's your allocation to fixed income at the moment? What's your strategy?
Again, we still have this view of a global economy that's expanding, that we do see sort of trend or below trend growth rates in many economies. And importantly, that's not a contraction. So that does mean leaning into credit as well. When we look at spreads and credit across investment grade and high yield, They are very narrow, but they can retain and be quite narrow and tight for a period of time, as they have been in the past, unless there is a big economic shock to come through. So we may actually see those spreads tighten a little bit. But really, if we look at the yields you can get an investment grade of around 4%, it's still very attractive on a carry. But more importantly, when we look at something like high yield, you're giving a yield of about 7%. We think about the potential for a bit of a capital gain. You're coming out to returns that could potentially be similar to equities. So it's about taking some at equity-like risk through the credit markets as well. And when it comes to government bonds, I mean, we've become a bit more neutral overall on duration, given that there's both risks around where yields could go in this environment, but preferring to think more about the steepening of the yield curve and how you would really play that through, given that we do see more potential for shorter yields to fall relative to long-term yields. And you actually have seen 10-year treasuries and even 10-year Australian bonds back up in yields over the last week or so.
Kerry, what's your view on China at the moment, particularly in the wake of the stimulus measures that have been announced, the massive moves we've seen on equity markets as a result? But then, of course, this week we've had a bit of a pullback, perhaps on disappointment that we haven't heard more from China.
Yeah, I mean, expectations are running high around the stimulus package going to come out. Obviously, we have a press announcement by the Ministry of Finance over this weekend. That would be, the group directed to try and obviously spend more money by the officials, and we could see something announced there. It's all about balancing market expectations. I think that there has been significant announcements in terms of what we've seen on the monetary policy side, support for lowering the mortgage rate, support for the property market that comes through with that, obviously support for the stock market through some of the relending facilities being made available to do stock buybacks or just buy stocks as well. So that's all very positive, and it's led to this big valuation re-rating we've seen come through in China, which has driven the market higher. But the next leg of that really is stimulus measures that are aimed at the consumer and aimed at the households to try and bring back that balance sheet into line, to try and address some of the overhang in the inventories in the property market, and really just get the economy back on track, because I think sentiment is very low at the moment. They're just trying to drive that wealth creation in households. So when it comes to that, I mean, there's been estimates of package announcements between 2 and 10 trillion Chinese yuan come through. Something like 2 trillion would be similar to what they've done in the past. And that's kind of where we see the benchmark for something that the market would expect and maybe would need to be beaten to see real upside surprise. But so much of it is going to come down to the detail of that package in terms of how it is focused on helping the consumers, how it is focused on how quickly that can come through, whether it's cash handouts, for example, as we saw in the US during COVID, or whether it's some other measures that come through to address the housing market and property developers. I think it is about the speed at which this can happen at the moment, not necessarily about the size of the package as well.